I'm going to start the new recording for chapter 2. Chapter 2. Now we're going to start now actually talking about managerial accounting finally. As you can see, the first lecture is more, the first chapter is more general, nothing on the managerial accounting, more like a little bit overview on the management accounting itself and the idea of the management accounting. Now what we have to do is go with the actual managerial accounting. First thing first, we're going to go to some cost terms, concepts, and classification. First thing, in order to have a product, we need three components. First, we need the direct material, we need direct labor, and we need a manufacturing overhead. And those coming in the order that you see them. First coming direct material. After that, we hiring people to work on the material. And the last thing comes is the overhead. So what's the direct material? Direct material is any raw materials or any materials which has to be used as an integral part of the product. So that material become an integral part of our product. The product that we're going to produce and the product that we're going to sell to our customers. Why is direct? Because it can be easily and conveniently traced to the product. Second will be the direct labor. Direct labor is something related to the labor cost, which can be easily and directly traced to the product or to the thing that we're producing that we're going to sell one day to our clients. The last thing is manufacturing overhead. What manufacturing overhead includes? That includes any indirect material that cannot be easily traced to the object or to the product. Any indirect labor that cannot be easily traced again to the object or to the product. And any other common cost which cannot be easily traced and allocated to every single product, but they still exist. That will be rent. That will be utilities, that will be insurance, that will be the depreciation of the machinery or equipment that we're using to produce those products. Anything like that, as you can see, it's very general, so it's very hard to be traced directly to every single product, but we're going to group them in one category. We're going to call it manufacturing overhead, and we're going to see later in the chapter 5 and in chapter 7, how we're going to allocate that manufacturing overhead to this product. Since we have the three components of the product, which are direct material, direct labor, manufacturing overhead, and since we already know that direct material is the first that comes and direct labor is the second that comes, we're going to combine direct material and direct labor, and we're going to call them the prime cost. Prime means first. Why? Because those are the two costs that comes first into the product. Then, since we know the direct labor and manufacturing overhead coming after the direct material, but we're using those two to convert something into product, we're going to call those direct labor and the manufacturing overhead conversion cost. So from here, as you can see, direct labor is part of both. Part of the prime cost and part of the conversion cost. Is the same direct labor. There's no difference between one direct labor and the other direct labor. That's the same number. So that opens here, by having this, that opens opportunity for so many questions here based on the information. So that's why I want you to be careful and we want to be comfortable. What's the conversion cost? What's the prime cost? And what's the total cost? Total product cost is direct material, direct labor, manufacturing overhead. So if I have a total cost and I have the prime cost, can you calculate the manufacturing overhead. Absolutely. The difference between one and the other will be manufacturing overhead. Why? Because the manufacturing overhead is not in the formula for the prime cost, and it's the last component that left. The prime cost is direct material, direct labor. Make sense?
Yes, Professor.
Good. Overtime premium. How are we going to treat the overtime? The overtime is the time that somebody works on the product above the regular time. The overtime, for the purpose of this course, we're going to treat it as a manufacturing overhead. Directly goes to the manufacturing overhead. Now, the non-manufacturing cost, this so far a manufacturing cost. Why? Because we're dealing with the production of the product. Those are manufacturing costs. How are we going to do what we're going to do with the non-manufacturing cost? Well, the non-manufacturing costs, we're going to directly expense them. Way on the income statement, of course. And which are those costs? Those are administrative, selling, marketing and selling costs first. Why? Because we still need to market and sell our products, as you remember, from the value chain. And the other thing is we need administration. We need those accountants to produce the reports and to work hard or not hard or hardly working. Depends on the accountant and depends on the motivation, depends on the ethical standard that this person holds. And the other thing is all those executive, organizational, clerical costs, those will be treated as a direct expense. They're not going to be accumulated in the product cost. Why? Because they're related to the organization itself. Even if we don't producing that product, we still have to have accountant to produce reports. So we're going to have again product cost and period cost. Product cost again is going to come from the product, which is direct material, direct labor, manufacturing overhead. First is going to go to the inventory on the balance sheet. And once we sell the inventory, it's going to go to the income statement as the cost of goods sold, where the period costs are directly expensed. They don't have to go first on the balance sheet and then to go to the income statement. So those are directly expensed on the income statement directly. Make sense? Tell me something so I can continue.
Yes.
Okay, good. Listen this, from time to time, I'm going to ask you, is this make sense or do you have anything? So I want to understand if you're getting the ideas. Because some of you may remember what's happened in the financial accounting, one, or some may not. And since the financial accounting is prerequisite for this course, I will assume that you know it. But if you don't know it, I can still explain it. But if you don't say anything, I'm just going to assume that you know it and going to move on. And that's going to create a problem for some of you. Don't be afraid to ask me questions. Don't be afraid to step up and say, hey, I'm sorry, I don't remember this. Can you please explain it? I'm okay with explaining, as long as you're okay with asking. If you're afraid of asking, so that's mean you're losing the opportunity to learn. All right, quick check. Which of the following costs will be considered period rather than product cost in the manufacturing company? What do you think about manufacturing equipment depreciation? Is this the product cost or the period cost?
Period.
It's for the manufacturing equipment. For what we're using the equipment? Is it used for production?
Yes. Yes.
Yes. So is it going to be period cost? Or going to be related to the product?
Product. It's related
Product.
to the product.
So that will be product cost. Okay, next one. Property taxes on the corporate headquarters. Corporate
Period.
headquarters.
Period
Period
cost.
cost. right? That's not related to any manufacturing and anything like that. So directly period cost. Good. Next one. Direct material cost.
Product.
Product cost directly, right? Next one. Electrical cost for the lights and production facility.
Product.
Product cost. Why? Because it's for the production facility.
For the production of them. Yeah.
Yes, it says production facility. So once it's related to production, that means it's product cost, right?
Okay.
Follow the terminology, please. So the last one is the sales commission.
It's a period.
That's cost, yes. So listen this. The electrical cost for the light of production facility will be the product cost. Why? Is because it's for the production. But if it says electrical cost for the lights of the corporate headquarters, that will be period cost. Then we cannot allocate that cost to the product. Why? Because it's for common cost for the company. Make sense?
Yes, Professor.
Yes, Professor. Okay. Let's keep going then. Those are the two period cost. Now, you have to compare merchandising and manufacturing company. In Canada, in general, you have three types of company. One is the sales company dealing only with the service company. Next one, the merchandising company. And the last one is the manufacturing company. Sales company, they usually don't keep inventory, right? Because they're selling service company, they just selling service. So they don't need inventory. If they have any inventory, that will be some office supplies or anything like that. Very, 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 very minimal. Merchandising company. Sorry? Sorry, is that for me or just a conversation? Is there any question here or no? Hello? Can I continue? Hello? Can you guys hear me?
Yes, teacher.
Yes,
You can continue, Professor. Yeah.
Okay. So merchandising company is going to have only one inventory account. What will be in that inventory account? Well, since it's a merchandiser, they're going to buy goods and going to sell the same goods. So if I buy computer, I'm going to sell computer. If I'm buying computer, can I sell cell phones?
No.
No, because I don't have them. I'm not buying cell phones and sell cell phones. I'm buying computers. So in that case, my inventory account is going to have only computers, not going to have a cell phone, right? Once I buy computers, I'm going to sell computers. If I start buying cell phones, then I can sell cell phones. Make sense? So whatever I'm buying, that's my inventory. That's what I'm selling. On the manufacturing company, then we're going to have few things. First, we're going to buy raw material. Then we're going to produce the product. And then we're going to sell the finished goods. So we're going to have more than one activity there. On the balance sheet, on the merchandising company, we're going to have only one inventory account, which is called merchandise inventory. Where in the manufacturing company, we're going to have three inventory accounts. First one will be for the raw material, which is the first component of the product, as you remember. Then we're going to have a work in process, something that's done, but it's not completed. We already start working on the material, but it's not completed. It's not final product yet. And the last one is the finished goods. Again, materials, raw material will be the materials which are waiting to be put in the production. Second one will be work in process, which will be anything which is on the stage of production, but it's not completed yet. And the last one is the finished goods or completed goods, which are waiting to be sold. For that reason, we're going to have a different format of the income statement. or calculation of the cost of goods sold. So before I continue with cost of goods sold, let's open one Excel spreadsheet and work a little bit on the Excel spreadsheet. Okay? I'm going to start from scratch, so you don't have to worry about it. Just give me a second. Let's start from the pure Excel spreadsheet, and let's work together. Some basic knowledge, so just to make sure that you have it. Can you see my screen?
Yes.
Yes.
Wonderful. Okay, great. Let's change this to 14 so it can become bigger, and let's make it a little bit more bigger like this. T accounts, what do you know about T accounts? Tell me, faster. What do you know about T accounts? Anyone knows anything about the T accounts? Oh, tell me something. Look like a T account.
Oh, can I, sir?
Huh?
Can I share something about the T accounts, which I learned
Please
from
say,
oh.
please do.
Okay, so for the T accounts, it has two sides, the debit, which is on the left side, and the credit on the right side.
Okay, great. Does this look like a T account? Can you see my screen?
Yes.
Yes.
Professor. It looks
Is
like
this true?
account.
Is this look like a T account?
Mm-hmm.
Okay.
Yes, Professor.
So what the T account has? Debit, credit. What else? Does it have beginning balance?
And balance.
Should be
Open
have
Balance
balance.
balance.
It depends. If it's balance sheet account, then have a beginning balance.
And
If it's not balance sheet account, then don't have beginning balance, no ending balance, right? So inventory is a balance sheet account. It has beginning balance and ending balance, and the normal balance is the debit balance, correct?
Yes.
Why is normal balance debit? Because who knows the basic accounting equation? What's the basic accounting equation?
Assets is equal liabilities.
Assets is equal to what?
Liabilities
Plus
plus equity.
equity. Excellent. So at this point, do you see assets equal to liability and equity? Let's make it even bigger. If I split, let's try something else. Plus, that will be should be plus, right? Not minus, plus. Right? So if I do this, split it by here, and I say this is debit, this is credit. Is that true?
Yes, Professor.
yes.
So that's how you should learn it. Assets is equal to liability and equity. What that means, assets always going to have normal balance debit. Liability and equity always going to have normal balance credit. Make sense?
Yes.
Yes.
And that's your T account right here. That's your balance sheet T account right here. Assets equal to liability and equity. debit, credit. Once you debit here, you have to credit here. Once you credit here, you have to debit here. Why? Because we want to keep it in balance.
Mhm.
If you debit here but don't credit here, then you don't have a balance. Make sense?
Yes.
Makes sense.
Okay. So let's focus now on the inventory. Question for you. If my beginning balance here is $5, on the debit side is my purchases, right? Correct? Whatever I purchase comes on the debit side. Make sense?
Makes sense.
Any pluses here, any additional here is going to come on the debit side. On this side, I'm going to have anything which is negative or minuses. Every time when I take out from this account, it's going to be minus, correct?
Correct.
Okay. If on the right side, on the inventory is my purchase, what will be on the debit credit side? On the credit side will be cost of goods sold. Why? Because I'm selling. I'm purchasing inventory and I'm selling inventory because I'm merchandising company. Make sense? So whatever I'm selling become cost of my sales or cost of goods sold. Why? Because I'm buying goods, I'm selling goods, and they have cost. So when I'm selling them, I'm having the sales price and then deducting cost of goods sold. I have here sales, and then I have cost of goods sold, which cost of goods sold directly coming from here. This is my cost of goods sold right here, coming from right from the inventory account. Then this is only for the merchandising company. Make sense?
Yes.
Professor.
So my ending balance, I have ending balance, let's say 10. So can I say here, now for the, when I have the T account, can I say my beginning balance plus my debits for the period are equal to my credits for the period plus my ending balance? Can I say that? Bigger. Can I say this?
Yes.
So once I know this, can I say my credit is equal to what? I want to express the credit only. What will be the credit equal to? Beginning balance plus debit minus ending balance. Can I do that?
Yeah.
But my credit is a cost of goods sold, correct? And my debit is the purchases. So can I say my cost of goods sold are equal to the beginning balance plus my purchases minus my ending balance? Can I do that?
Yes, Professor.
Okay. In other words, for the girls, careful here. This is question for the part. $5 in your pocket. You want to go for shopping in Metro Town, but $5 not going to help you. So you're going, you withdraw another $10. You shop what you shop. You're going back home, and you found your pocket $3. How many dollars you spend in Metro Town?
Sure.
12.
Sorry,
12.
sorry,
12.
12. Does that make sense?
Oh.
So what will be? I'm chasing cost of goods sold. That's how much I spent. I had $5. I add another $10, and when I went home, I found $3. How much I spent? $12. That's your calculation of the T accounts. That's how difficult it is to you to calculate the T accounts. If you wonder what's happening here, always imagine this. I have $3 in my pocket. I put another $5. I spent $6. How many dollars left?
$2.
$2. I need you to be fast on this.
Yes, Professor, $2.
Okay? Got it?
Got it.
Good. That's for the merchandising company. Let's see the same thing. Let's see what's happening now in the manufacturing company. Manufacturing company. In the manufacturing company, as we said, we're going to have how many accounts? Inventory accounts? What was it? How many inventory accounts we're going to have? Accounts, right? First will be raw material. And we're going to copy this and I'm going to put it here, and that will be my working process. Yes, correct. Working process. And the last one will be
Finished goods.
finished goods, correct. So from which account I'm going to get cost of goods sold? From which account cost of goods sold is going to come? From the raw material, working process, or finished goods?
Finished goods.
Finished goods, that's correct. Cost of goods sold, in this case, we're going to come from the finished goods. And then we're going to have here sales, cost of goods sold. Right? Let's get this arrow from here, copy it, and move it right in here. Everybody with me?
Yes.
Okay, excellent. Now, raw materials. We're purchasing the raw materials. We're purchasing. Then we use the raw materials, right? Raw materials used. We're using raw materials. Why are we using raw materials? Because here in the working process, in order to produce product, what do we need? What was the product cost? Direct material, direct labor, manufacturing overhead, correct?
Mhm.
Oh, we're using those materials here, and we transferred some of them here as a direct material. Then we're getting the direct labor, manufacturing overhead, and here what we're going to have? That's new term, which is cost of good manufactured. Then the cost of good manufacture is going to come to the finished goods. Cost of good manufacture is going to come with the finished goods. And then we're going to, once we sell the finished goods, we're going to get the cost of goods sold. Make sense?
Everything's connected. Yeah, makes sense.
Right. If you want to update this formula, this will be correct for each of those accounts, correct? On this case, we're going to have raw material used. Here we're going to have cost of goods manufactured will be equal, cost of goods manufactured, that will be equal to beginning balance plus, here we're going to have direct material plus direct labor plus manufacturing overhead. Right? And here we're going to have, actually, this one's going to come, I can use this formula here on this account. I have cost of goods sold equal to the beginning balance plus cost of goods manufactured minus the ending balance, correct? Are you following me, people?
Yes, Professor.
Yes, Professor.
Okay,
Professor.
so in order to get a good cost of goods sold, what do I need? I need the beginning balance, ending balance, and cost of goods manufactured, right?
Yes.
Yes, exactly.
But in order to get the cost of goods manufactured, what do I need? In order to get the cost of goods manufactured, I need beginning balance, ending balance, plus direct material, direct labor manufacturing overhead during the period of time, right? Direct material, I can get it from the raw materials. Direct labor manufacturing overhead, they're going to come directly. So so you understand now, in order here for the manufacturing company to get the cost of goods sold, first I have to get cost of goods manufactured, cost that will be C here, cost of goods manufactured. But the cost of goods manufactured, I can get it through the work in process account. But direct material, which is part of the work in process, I have to get it from the raw materials. So in here, we said sales minus cost of goods sold, correct? Let's put the numbers here. Let's selling for 20. Cost of goods sold, or how much is my cost of goods sold in this case? Let's purchase, how much you want to purchase? Let's purchase 15. So how much is my cost of goods sold here? Tell me quickly, how much is my cost of goods sold?
5 plus 15.
10. Okay, so 10 coming here. So that's one way to show it, right? 20 minus 10, that will be equal to this one minus this one, and that will be my gross margin. Correct? That's one way to show it. The other way to show it will be sales is 20. Let's put it left here, 20. And in order to get the cost of goods sold, I'm going to go with the beginning balance on the inventory, which is, in this case, is 5. Then we're going to add purchases, and that's another 15. And then I'm going to have here calculation, which I'm going to call it goods available for sale. And that will be equal to 20 less ending balance, correct? Once I deduct the ending balance, which is 10, I'm going to have cost of goods sold. Make sense?
Yes, Prof.
So my cost of goods sold here will be right here. And then I'm going to get gross margin. It will be equal to 20 minus 10. Did I get the same result?
Yes, Prof.
Here I'm getting the same result. What's the difference? Here I'm showing this calculation. Beginning balance plus the purchases minus the ending balance give me cost of goods sold. That's exactly the calculation that I'm showing. Make sense?
Yeah.
Yes.
Nothing more, nothing less. So I can either get it directly cost of goods sold, or I can express it beginning plus the purchases going to give me available for sale minus the ending balance going to give me cost of goods sold, which is exactly this formula: cost plus beginning balance plus the purchases minus the ending balance. Now, what we're going to do in the manufacturing company? Again, in order to get the cost of goods sold, first we have to get cost of goods manufactured. So that's why here we have to prepare schedule for cost of goods manufactured. In order to do that, obviously, first component here, to get this number, first what we need 1, 2, 3 things. Then we need beginning balance, and then we need the ending balance. So in order to prepare cost of goods schedule for cost of good manufacture, we're going to start with the direct material first. That's the first component, direct material. Well, but for direct material, we have to get the raw material account. As you remember here, we express this entry. In this case, to get the material use, we have to express this entry. So what we're going to start? We're going to start beginning balance, raw material. And that beginning balance, let's go with the actual number. Let's go with the actual number is 5. Then we're going to have add purchases, because we're going to purchase raw material, direct material. We purchase, how much we purchase? Give me a number for the purchases quickly.
10.
10. And then we have raw materials available, which will be calculation between those two. Then what we have to do? We have to deduct less ending balance on the raw material, which is in our case is 10. So how much is the direct material used? Or shall we, let's reduce this number, let's reduce it to 3. Let's reduce 1 to 3. So ending balance here is 3. So how much is the raw material used? 15 minus 3, 12. Let's put the number here. We have here purchase 10 and we use 12. We in balance, correct? Make sense?
Makes sense.
Yes.
So we use 12. We have the first thing. We have the direct material. Second thing is direct labor. Direct labor usually is given. Let's say direct labor. How much you say for direct labor? Give me a number for direct labor.
7.
10. I'm trying to keep it everything on one screen. That's the objective here. 10 for direct labor. Then what's the last thing? Manufacturing overhead, correct? Right?
Yes.
How much? Give me a number for the manufacturing overhead.
16.
A good number, 15. So once we get direct material, direct labor, manufacturing overhead, can we say that we have product cost for the period? Can I say that?
Yes.
And my product cost is 37. So what do I need? I have my debit now. I have those 3. I have here 12. I have here 10. I have here 50. What do I need? I
Beginning
need
and
to
ending.
add
Beginning and ending balance.
beginning balance on the work in process account. Give me example for beginning balance. How much you want to be?
14.
14. Good. 14. And then once I add this, I'm going to make a calculation. And we're going to say our product cost, total product cost. What I have to do to get the cost of goods manufactured? I have to less ending balance on the work in process account, correct? Once I deduct the ending balance, give me example for the ending balance.
9.
less 9, what I'm gonna get? Once I deduct 9, what I'm gonna get? What's my next line? Who's gonna tell me what's my next line? What should I write here?
Cost of goods manufactured.
Cost of goods manufactured. Excellent. Goods manufactured. In other thing, cost of goods manufactured. And I did the schedule for cost of goods manufactured. Now, if I want to do the schedule of the cost of goods sold, what do I have to do? If I want to do the schedule of cost of goods sold, what do I have to do?
You need the beginning balance for the finished goods.
Exactly. Let's do that. Let's first remove this. So here I'm going to have cost of goods manufactured. Now, once I have cost of goods manufactured, what do I have to do? I have to add beginning balance on the finished goods account, which is 5 is 5, okay? Let's go with 5. And then we're going to have a new calculation, which is called finished goods available for sale. In some books, they can go with the cost of goods manufactured available for sale. Either way is correct. And once we do that, what's left to get this number? I have to deduct
Ending balance.
the ending balance less ending balance of the finished goods account. And that's going to give me what we're chasing, cost of goods sold, correct?
Yes, Professor.
And that will be cost of goods sold. Ending balance is 10. So my cost of goods sold will be 47 minus 10, or 37. Make sense?
Makes sense.
Yes.
Yes, Prof.
How is it? Is it hard?
No.
During the hard part.
Basically, what you have to do, you have to do this calculation 3 times for the manufacturing company. First, to get the raw materials, direct material used. Then you have to do for the working process to get the cost of goods manufactured. And the last thing is to do for the finished goods to get the cost of goods sold. All right. So once we have this, let's go back to the slides. I'm going to keep you for a few more minutes and then I'm going to let you go. I'm going to continue next time. So first presentation is for the merchandising company to prepare the income statement is we have to get the cost of goods sold. How are we going to get it? We're going to get the beginning balance. We're going to add the purchases. We're going to get goods available for sale. We're going to deduct the ending balance and we're going to get cost of goods sold. For the manufacturing company, now we have to work with the finished goods account. So we have beginning balance on the finished goods account, cost of goods manufactured, then we have goods available for sale. Minus the ending balance, we're going to get cost of goods sold. At this point, we're coming to the basic equation in the inventory account, which is beginning balance plus the additional or purchases or additional to inventory is equal to the ending balance plus credits or withdrawals from the inventory. So this is debit, this is credit. Let's do one quick check. If your inventory balance at the beginning of the month was 1,000, you bought 100, you sold 300. What's your balance at the end? You had $1,000 in your pocket. You withdraw $100. You purchase, you went to Metrotown, you spent $300. How many dollars you have?
800.
800. Okay, with Metrotown works. When we switch to when we switch to inventory, it's hard.
Mhm.
But it's the same thing, isn't it? It's exactly the same thing. Either gonna call it inventory, either gonna go shopping in Metrotown, it doesn't matter. The result always will be the same. Yes, 800 is the correct one. So we have 1,000 plus 100 minus 300, gonna 8,000. Now, schedule cost of good manufacture. In order to get the schedule for the cost of good manufacture, we have to calculate the cost of the raw material, direct labor, manufacturing overhead, which are used for the production. Calculate what we're doing here, calculate the manufacturing costs associated with the goods that were finished during the period. How are we going to get? From the raw material. Raw material, we're going to get beginning balance in the raw material inventory. We're going to add the purchases. We're going to have raw material available to use. We're going to deduct the ending balance, and we're going to get raw material used in production. That will be the direct material. Direct labor and manufacturing overhead, they just going to come. Once we combine this one, we have the total product cost or total manufacturing cost. So what we have to do here, we have to add the beginning balance in the working process, the ending balance in the working process, and we're going to get cost of goods manufactured. And this is the cost, how much cost us to produce the products which are now available for sale. So if you want to continue to the cost of goods sold, what we have to do, we have to add the beginning balance on the finished goods account, deduct the gonna get cost of goods was available for sale, deduct the ending balance of the finished goods, and we're gonna get cost of goods sold. So the flow of the information is this: cost, which is the product cost, which is raw material, direct labor, manufacturing overhead, first gonna go to the balance sheet. Raw material have the separate account, which is raw material account. Raw material is gonna move to the work in process account. There, in the working process, the three product costs gonna meet. So there we're gonna have direct material, direct labor, manufacturing overhead. Once we have those three, we can say we have a product now. Once we have the product, that becomes cost of goods manufactured, move to the finished goods account, and to finished goods when we sell it, become cost of goods sold. The period costs, which are selling administrative expenses, they're directly expensed in the income statement. So the example here will be direct material, go to the raw material, then meet direct labor overhead into the work in process account. From the work in process account, moving to the finished goods account. We're getting beginning balance minus the ending balance, and that's moving to the cost. Once it's sold, go to cost of goods sold. Selling administrative expenses, those are directly expensed. Let's do a few checks now to see if you actually understand it. Raw material, beginning balance for the raw material inventory was 32. During the month, 276 was purchased. At the end of the month, we count the raw material, we found 28,000. What's the cost of direct material used? 280,000. Is it? Or more? 280. So what we're going to do? Beginning balance plus the purchases minus the ending balance going to give it 280. The other thing that the other way you can think is my beginning balance is 32. My ending balance is 28. So for my beginning balance, I use additional 4,000. 276 I purchase and I use 4 more. That's 280. That's my answer. That's another way you to calculate it faster. So here, direct material used in production total 280. Direct labor was 375. The overhead was 180. What's the total manufacturing cost for the month?
$835.
835. Thank you. What we're going to do, we're going to combine 1, 2, 3, get the total. So beginning work in process was 125. Manufacturing overhead during the period was 835. There were 200,000 partially finished goods remaining. So the ending balance is 200,000. What was the cost of goods manufactured?
$760.
760. How did you get it?
I
think it's 910.
How did you get this number? What's the logic here? We have the beginning balance 125 plus 835. How much is it?
960.
960 minus,
The ending inventory.
which is 200. How much left?
760.
760.
Everybody get that number?
Yes.
Yes.
Good. That should be the correct answer, correct?
Yeah. 760.
Let's see if that's true. Yes, it is. So we're getting the beginning balance, we get the production during the month, minus the ending balance, and we're getting the cost of goods manufactured. Next question. Since we have the beginning finished goods, balance is 130, we get the cost of goods manufactured, which is 760, which gives us 890 available for sale. Ending balance is 150. How much is the cost of goods sold?
B
E?
740.
740. Yes.
Okay. So what we have,
740.
130 plus 760, that's 890, minus 150, 740. Good. So, classification, quick classification. What we learned so far, we have a product cost and we have a period cost. Product cost is direct material, direct labor, manufacturing cost, manufacturing overhead. Period cost is marketing, selling, or administrative expenses. Period cost directly is expensed. Product cost goes to the inventory, and when the product is sold, become expense in the cost of goods sold. For predicting the cost behavior, we're going to see later. Next time we have a variable cost and fixed cost. When we are assigning the cost to the object, we have direct cost, which is direct material, direct labor, and indirect cost, which is the manufacturing overhead. And for decision making, which we're going to see next time, we have a differential cost, sunk cost, and opportunity cost. And I'm going to stop here. for today. That was great. Thank you for your participation today. And if you have questions, please ask me. If you don't have questions, enjoy the rest of your day and the rest of your week. Have a great weekend, and you're going to hear from me next Wednesday.
Thank you.
Thank you, Professor.
Thank you, Professor.
Professor.
Thank you, guys.
Thank you.
Thank you, Professor.